morning, everyone. We are the Lomonosov Moscow State University, and we would like to introduce you to Moscow, the leading infrastructure construction company in Russia. We give it a strong buy rating, which is supported by a number of reasons. So first, Moscow is an apparent leader in a very attractive industry. Second, it is a quality value investment, which at the same time offers an impressive growth profile. Third, it is clearly undervalued by the market and provides a huge upside potential of 77% by the end of the year. There are two more reasons that support our recommendation, which we will discuss later on. And I'll pass it on to Malika to discuss the first reason in more detail.
Thank you, Rasul. Russia is a very prospective country to invest in because it is one of the biggest emerging markets with a GDP growth of 4.3%. In order to keep this growth sustainable, Russia will need to renovate and rebuild its depreciated and overloaded transport infrastructure. It is estimated that the Russian economy loses up to 3% of GDP annually in the form of unearned revenue because of the poor state of its transport infrastructure. It is expected that the investments in transport infrastructure will amount for $450 billion by 2017, pushing the market to grow at an average annual rate of 12.6% from 2012 to 2017. Moreover, the demand for construction works is further heated as Russia will be hosting the high-profile projects like Sochi Winter Olympics and FIFA World Cup. In this fast-moving and attractive industry, open joint stock company Moscow is an apparent leader. Moscow has 8.6% market share, you can see it on the slide, which is 2 times greater than a market share of its closest competitors. During its 80-year history, Moscow has successfully completed over 7,500 projects in construction of roads, railroads, airports, and ports. Its technological expertise and together with its general contractor competencies enables it to undertake large-scale projects of any complexity. Moscow operates in the most economically prosperous regions of Russia. You can see it on the map: Central Federal District and Southern Federal District. Nevertheless, the company has exposure to other prospective regions of Russia, like Russian Far East and Siberian markets. Summing it up, we think that Moscow's sustainable positions in the industry will enable it to benefit from ongoing investments, and we see it as a leading company in a rapidly developing and prospective market, which is the first reason why it deserves our buy recommendation. I now pass it on to Rasul to discuss the second reason why Moscow is given buy recommendation.
Thank you, Malika. So, dear judges, as we said, we believe that Moscow is a unique combination of value and growth, which rarely goes together. In fact, we checked it against a set of criteria used by FTSE to identify quality value investments in emerging markets. So, according to the organization, a value stock must possess an attractive dividend story as well as a quality financial profile. And as you can see on the slide, the company pays out over 50% of net income, which currently translates in a dividend yield of 4.5% compared to only 2% global industry average. This in fact makes Moscow one of the top 5 non-oil and gas companies in Russia by dividend yield, which indeed highlights the attractiveness of its dividend story. Moving on to the financial profile, we see that it's very strong too, as return on equity of almost 20% is seen very healthy, and we expect it to improve even further, primarily driven by high efficiency. The EBITDA margin stands at 9.7%, which is in line with the industry average, and the use of leverage is very prudent, which is best demonstrated by Moscow's negative net debt to EBITDA ratio of -2.3 times. The liquidity position is also another strength of the company, as Moscow constantly ends every year with a significant amount of net cash, and we expect the 2011 net cash position to stand at about $309 million US. And last but not least, the company has a very strong potential to generate revenue, and we expect its top line to demonstrate tremendous 15% annual growth rate over the next 5 years, with the current backlog worth almost $10 billion US, covering as much as 3 times the 2011 revenue. So with us, conclude that Moscow is indeed a quality value stock offering tremendous growth prospects. I now turn it over to Ekaterina to discuss our valuation.
Thank you, Rasul. Now, our target price for the company is $9.3 per share, which implies 77% of upside potential. In our valuation, we use DCF and multiple approaches. Considering DCF, the enterprise value is mainly driven by growing government expenditures to infrastructure construction and increase in market shares of high margin segments. Company's free cash flows is discounted at 15.5% of weighted average cost of capital, which reflects all of the risks associated with cash flow generation. In multiple approach, we compare Moscow Trust with three groups of international companies. First of all, is diversified infrastructure constructors, general contractors, and toll road operators. Moscow Trust provides 40% discount to its peers, which confirms our buy recommendation. Now, let me introduce you to corporate governance performance because it's one of the most important factors for the investor. Thank you, Rasul. Moscow Trust complies with all listing requirements and also complies with best practices of international companies which are listed in London. Strategic shareholders have extensive industry experience and also have a strong interest in the company's growth. Minority interests are also in line with their interests are also in line with current business strategy, and their rights are also protected by board of directors, 2 independent directors, and a representative of Investment Protection Association. In this way, we are certain that high standards of corporate governance performance is a one more factor of Moscow Trust investment attractiveness. Now I'll pass it to Nikita to talk more about major risks.
Thank you, Katerina. As you've seen, our valuation implies an impressive upside potential. Nevertheless, we've been conservative in our analysis and have considered all major risks that could affect our target price. So, first of all, low demand for construction works due to weaker macroeconomic situation can negatively affect company's revenue. However, demand for Moscow services will continue to be in a high level even under worsening economy, because the government has already approved their spending plans and the private sector is also starting to invest in transport infrastructure. Secondly, the revenues can be negatively affected by political changes. They could turn investment away from transport infrastructure. Yet this is very unlikely because transport infrastructure development is a national priority and cannot be postponed because of this poor state. These were two the most significant factors for risk. The others include intense competition in infrastructure industry, higher project costs, higher than expected project costs, and liquidity problems due to unpaid debtors. In our view, the company can easily deal with these two, as you can see on this slide. So, in this way, our target price seems to be resonant to all major risks, and that supports our buy recommendation. Now I'll pass it to Rasul to make the final conclusion.
Thank you, Nikita. So, dear audience, having considered that Moscow Trust is an apparent leader in a very attractive industry, that it is a unique combination of value and growth, and that it is severely undervalued by the market, we give it a buy recommendation, which is further strengthened by its high standards of corporate governance and the fact that all major risk factors that could negatively affect our target price are mitigated and will not have any significant impact. Thank you very much for your attention. We are now glad to answer your questions.